Thank you for the introduction. It's a pleasure to be with everyone here today virtually. Hopefully one day we can return to meeting up in person soon. So just before we get into the content on the US digital dollar and stablecoins, I want to briefly introduce blockchain.com and tell you a bit about us. So we've been around since 2011. We're one of the oldest crypto asset companies, probably best known for our wallet. We've had over 50 million wallets created on our platform. Our Explorer is also quite popular, as is our API. And some of our newer products that are attracting a lot of attention include our exchange and our interest accounts. You can currently earn 12% annually on US dollar stablecoin deposits, which is quite attractive in an environment like this one where people are getting zero or even negative interest rates. We also host a monthly Outlook that myself and co-founder Nick Carey manage. We'll be hosting one tomorrow, which we'd love for you to join. It's a webinar. We publish also on the blog the contents of that webinar if you can't join. But we try to share, for example, unique data from our platform on these calls. At various times, the blockchain.com wallet can represent 25% of the total Bitcoin network traffic. And that gives us a unique position to share insights into what countries we're seeing increased activity and where we're seeing declines, and to talk about why that might be the case. So please come join us on our webinar or check out our blog. So to get into the topic today of the US digital dollar, it really makes sense to start with the topic of stablecoins, which have inspired a lot of the discussion of central bank digital currencies like the US digital dollar. And it's probably no big news flash for the folks on this call to talk about how crypto assets have notoriously been very volatile. Bitcoin is much more volatile than other fiat currencies and even other commodities like gold, of course. And so starting in 2014, we saw the advent of stablecoins, the introduction of Tether, which really took off in use in the 2016 timeframe on exchanges like Poloniex that did not have access to US dollar bank accounts and could not offer their users any other way to trade out of more volatile crypto assets into something more stable. So Tether really inspired the huge growth in the number of stablecoins we really saw starting in 2017. And then today we've got some major stablecoins alongside Tether, which we'll talk more about here in a second. But that's kind of a brief timeline of the kind of history of stablecoins. And all of these slides, by the way, can be found in our two major state of stablecoins research reports that we published over the last 2 years. You can download those for free from the blockchain.com research page. So this year, stablecoins have continued their dramatic growth. We've just seen them double in total value from around 10 billion at the beginning of the summer to over 20 billion recently. And that's a 10x increase in the total market value of all stablecoins since last year. We've got Tether still representing kind of the majority of that value at over 15 billion in value, but its market share dominance has slipped. When we started looking at stablecoins in 2018, Tether represented 98, 97% of the total value. Earlier this summer, it was around 85%. It's now down under 80% to more like 75%. We've seen USD coin cross over $1 billion this year, and now it's close to 3 billion in size, about to enter the top 10 alongside Tether as one of the 10 largest crypto assets by market value. And MakerDAI also seems set to cross over $1 billion in value here soon. So we've seen a diversification in the number of stablecoins that are growing and just a massive growth in the sector. And why is that? What's driving this growth? And this is, again, part of the story behind why we're seeing such an interest in central bank digital currencies like the US digital dollar. Well, traditionally, stablecoins have been used, as I mentioned, as a way to kind of risk off and move out of more volatile crypto assets, but we're starting to see them used, for more cross-border payments and use as a store of value. There's reports out of Asia, always difficult to get really precise data here, but definitely some anecdotal information coming to fore that people are moving funds offshore using stablecoins. And then in the crypto space, we're starting to see stablecoins used in the lending and borrowing sector, both on decentralized platforms like Compound, as well as more centralized digital asset lending platforms like blockchain.com, where again, we're offering 12% annual interest rates. That's incredibly attractive for people looking to earn a return on their US dollars compared to what they can earn in a bank account. And that's, I think, a big part of what's driving the growth of stablecoins today as well. Now, when we think about how a US digital dollar might be designed, it's worth, again, reviewing the framework that we developed for kind of classifying different types of stablecoins. And the most popular and largest of the three buckets that we've used for classifying stablecoins is the traditional collateral bucket. So these are stablecoins like Tether, like USD Coin, which have US dollars held in reserve, typically at a bank account, or other US dollar equivalent assets that are backing the digital token that's issued on a blockchain like Ethereum or others now. And that's, the biggest category by far. But as I mentioned, MakerDAI is growing, and the crypto collateral category, the second category, is becoming more significant as well. These are stable coins that don't hold, say, their collateral in a traditional bank, but actually use crypto assets like ETH in the case of MakerDAI to back the value of the stable coin. And that crypto collateral is adjusted to maintain that peg. And then the third category that has received less, has seen less activity is the algorithmic category. And here what we really mean is a stable coin that doesn't have any kind of asset like a US dollar bank deposit or crypto backing it. I mean, you could argue that some algorithmic stablecoins have other things backing it, like their fee structure, their fee income, and so on. But this is a category that really tries to automate the stability mechanism without trying to have some kind of asset that could be converted to maintain a peg and provide stability. And so we think about a US digital dollar, it really represents potentially the ultimate algorithmic stablecoin because it would not have a traditional asset necessarily directly backing it. It wouldn't be linked to gold like today's US dollar is not linked to gold anymore. Sure, it has the backing of the full faith and credit of the US government, the US military, the taxing authority of Congress, and so on and so forth. But there's no asset really backing it directly that can be converted into US dollars. And so the US digital dollar would really be an algorithmic stablecoin in some ways. So we published this summer a blog post titled "The Coming U.S. Digital Dollar," the same title as this presentation, what it is and why it matters. And that title, and the suggestion that not only is a U.S. digital dollar inevitable, but potentially imminent, would be very controversial if we were just to kind of wind back the clock 12 to 18 months ago. At that time, I don't think anyone would have argued that the U.S. digital dollar was not only inevitable but imminent. And so it's worth reviewing what's driven that change. Why is this something that is now top of mind? When just even at the beginning of this year, organizations like the Bank of International Settlements said central bank digital currency was not a priority, having a hard time seeing the justification for it. What's changed? Well, really three big things have happened in the last 18 months or so that have driven this, in addition to the rise of stablecoins, which are a factor. But I would say arguably these three are bigger factors in what's pushed the U.S. digital dollar to the front of the agenda. So first, in June of last year, Libra was announced. This is the Facebook-led consortium that really validated the ability of blockchain technology to accommodate billions of users. That was a big roadblock based on my early research back when I was at Cambridge in 2017 as to whether or not central bank digital currencies were viable. A lot of the testing that was going on at that time suggested there just wasn't the infrastructure capability to accommodate billions of users for something like US digital dollar. But Libra, I think, put policymakers and central bankers on notice that there was really now a belief that this technology could scale to that size. The second big driver, of course, has been the coronavirus this year, really illustrating painfully how antiquated money is today, how slow it is to send funds. People getting physical checks. Sometimes these checks are even sent internationally, taking weeks, getting lost, billions getting sent to people who are dead. And so the coronavirus has highlighted in a major way the need to digitize further our financial payments infrastructure and money. And then I would argue that the third factor, which is rising US-China trade tensions, is actually the most durable and most significant of the three factors, major factors that have driven the US digital dollar to the top of the agenda. So China has its own central bank digital currency, the DCP, that is in testing. And it supposedly was accelerated for launch after Libra was announced last year. And as US and Chinese trade tensions have risen, we've seen concern rising inside the United States that the Chinese DCP, a digital yuan, potentially poses a threat to the US digital dollar's role as the dominant currency around the world. The US needs to kind of keep pace with China. And we're now in a situation where today, amazingly, we have two of the largest economies, the two largest economies really out in the front in some ways of introducing digital central bank currencies. Whereas a year ago, I think many folks, myself included, expected smaller countries, maybe a country in the Caribbean or perhaps a Sweden, might be one of the first to introduce a central bank digital currency. Instead, the tables have been turned, and now you have the largest economies potentially out in front. And the reason why number three here, that US-China tensions is so significant, is really it's the one force that the US can't totally kind of control really on its own. I mean, Libra is something that in theory policymakers could shut down if they wanted to. The coronavirus, there's a general consensus that this is something that will pass and will go away and we'll have a vaccine for. Remains to be seen, of course, but the US-China trade tensions are seen as persistent and something that the US can't really let itself get too far behind on. So that's really driving, I think, a lot of the interest in the US digital dollar and making it a priority right now. Now, there have been huge obstacles when the subject of central bank digital currency has come up in the past, probably the most significant being the concern about exacerbating bank runs or even helping to trigger a financial crisis. If the equivalent of cash existed in digital form that individuals during a panic could run into digitally, not have to stand in line like these folks did during the Great Depression, to flee the commercial banking system, which is exposed in any kind of panic. That digital exit ramp into a digital dollar, into the safe confines of the Federal Reserve, banking system could really heighten any kind of major crisis. And so this is a real conundrum, and it's by no means solved, that policymakers and central bankers will need to kind of wrestle with if they think about how to design a working central bank digital currency. However, the case is, I think, really compelling now. As I mentioned, I'll just highlight a few other things about the recent coronavirus and stimulus that went out that really make the case for why the US needs a digital dollar. Imagine if one was in place back in March, April, as these stimulus checks were cut. You could have cash in people's hands nearly instantaneously. You could send funds to the people who are most at risk, who may lack a physical address, or if they're a student, they may have had to move. You wouldn't be worried about a check going somewhere where someone isn't. You could track and make sure that funds were delivered. You could help maybe cut down on the use of physical cash. There's been concerns about how interacting with physical cash could exacerbate the spread of the virus. So there's huge benefits that could have been realized had a digital dollar existed earlier this year when these checks were cut, that I think overwhelm some of the concerns around, well, can we design this so that banks aren't weakened during a crisis? One of the questions that comes up with the US digital dollar is, what happens to something like Bitcoin or stable coins? And I've heard from policymakers, they've asked me, does the introduction of a central bank digital currency, does that cause stable coins to go away? Does that cause something like Bitcoin to go away? And I think the answer to that is no. that they're actually more complementary than directly competitive. And the reason is because a digital dollar, even though a lot of the, as we'll discuss here in a moment, precise design characteristics are still being debated, we can be pretty certain that it's not going to be a copy and paste of a cryptocurrency or a stable coin. It might be closer in design to stable coins, might even leverage stable coins in some way, but likely to be quite different than something like Bitcoin. So you may see something like a US digital dollar looking to replicate, say, the technical resilience of something like Bitcoin. Bitcoin certainly was actually the original inspiration for central bank digital currencies. Some people on this webinar might remember some of the 2012, 2013 blogs like FedCoin by JP Koning and others that really inspired and kickstarted the conversations around central bank digital currency. But it's unlikely we're going to see a full copy and paste of all of Bitcoin's characteristics. The decentralization versus centralization of a central bank digital currency is a critical question. There have been some proposals that argue for simply expanding the Fed's current account-based system, where commercial banks and some foreign governments and international institutions like the IMF, they hold accounts at the New York Fed. Simply expanding that existing system. That was the basic proposal that was put forward to Congress in the spring after the coronavirus outbreak. That would be a highly centralized system. It is a centralized system. Would something become more tokenized? That's the term that you'll often hear used when people are talking about a more decentralized approach, where the US digital dollar would more closely resemble something like cash, a bearer instrument where possession, regardless of whether or not the possession is legitimate or legal, confers the ability to spend, and it would have more censorship resistance. That's a heavily debated kind of point around how to design US digital dollar. The other critical question, of course, is the privacy, and it's related to this centralization versus decentralization question. I think the key thing I'd like to share here is I think this question is really something that's going to get escalated or kicked upstairs to policymakers, and is not something that's at the central bank level to really decide. The degree of privacy that a central bank digital currency like US digital dollar will have is really a legislative question. It's a question for citizens. And I think central bankers may weigh in on it. They'll certainly weigh in, of course, on the design and what's the right technical balance here to achieve certain trade-offs and so on and so forth. But this is really a policy question that's going to be probably decided by, in the US's case, by Congress, not at the central bank level. And there's a lot to still be determined, I think, about what the right balance is here. The last thing I would wrap up with is a comment on security, and it comes out of discussions that I've been involved with this summer. There's been groups assembled to talk about central bank digital currency and US digital dollar. And one of the concerns I flagged was that a lot of the discussion was coming from a more monetary theory perspective and attempting to design a US digital dollar with a more economic perspective first, rather than thinking about what do we need to do to make this system secure. We've written on our blog about how any kind of breach of a US digital dollar could create the mother of all financial crises. And you need to start with security first when you're thinking about building something like this. And from there, a lot of your design choices will flow naturally. And it's encouraging to see the Fed reaching out to MIT and cooperating with academics and institutions like MIT that hopefully will help bring security more to the forefront in discussions about how to design. And from that will flow, I think, some more natural design choices about how to construct this thing. So just running out of time here now. If you would like to check out these slides or learn more about our work on stablecoins and the digital dollar, come to blockchain.com and check out our research tab or our blog, and we'd love to see you on a monthly webinar in the future. Thank you very much.